I think, again, because inflation is a lagging indicator, which actually tells us where we were in the real economy 6 to 9 months ago, that is why we are seeing and hearing these talks, because people are saying, oh, but things are, inflation is a problem. Inflation is not a problem at this point. Deflation will soon be. And that's because the Fed is way too hawkish at this point, way too hawkish. And we are probably heading into almost a recession before the Fed actually understands it. And I see in 25 here, we'll see emergency cuts. Again, coming back to 2007, 2008, you actually saw that how the Fed, as I said, the 31st of October was focusing on this. This was in the quarter where the economy was already contracting, and it contracted by 1.6% in Q4 2007, and the Fed was talking about inflation. I mean, it's so ridiculous. And in January of 2008, which was just 2 months after the FOMC statement where they talked about that, the Fed was panic cutting, first by 75 basis point by mid-January of 2008, and then by another 50 14 days later. This is how data dependent the Fed is. They probably are, but they are looking at lagging indicators. They're looking at things that are not in the front window. So, but what was happening earlier on, and that is a mistake. So I think they're doing the same mistake, and this time even more bigger than that.
On this episode of What the Finance podcast, I have the pleasure of welcoming back a very popular guest, Henrik Zeberg. So Henrik is a macro economist, founder and publisher of the Zeberg Report. So Henrik, thanks so much for coming back on the podcast today.
Thank you very much for having me on.
No problem. Looking forward to the conversation. We were just sort of talking beforehand. I think last time we spoke, it was sort of early last year, middle of last year, where the economy had sort of been doing quite well. You were expecting maybe it would to fall off a little bit because a lot of the leading indicators have shown weakness, but it has been quite surprising, and the economy has sort of remained strong, at least in the US, it seems. So have you been surprised by the resilience?
Well, I mean, again, it's how you look at things. So, like anything else, and like before, we always see that there is kind of a period where people think, oh, things are great, and then they are not so great. So it depends on how you look at them. And again, yes, there is not a recession at this point. I give you that, but I'm not agreeing with the numbers that we see from NFP, or the NFP numbers that we see coming out. And you can just, there are so many ways of just dissecting those and then just saying, okay, it really seems like the emperor still does not wear any clothes, honestly. So yeah, the economy, the U.S. economy is definitely still strong. The European economies are not strong. Germany again posted some bad numbers. We see China is falling over the edge right now, and I also think things are not too great in Japan, if I have to say. So I think it's about the perspective of things and saying, yeah, right now we're not Titanic has hit the iceberg, but it doesn't mean that it's underwater completely yet. But there are definitely weak points, and I do not buy it for 1 second that we are now seeing a soft landing still. I mean, it's simply too obvious that we don't.
Okay, so you think, maybe because I was going to talk about this later in the interview, but we see Trump coming in. It seems like lots of people, this will actually go out after the inauguration. So then we'll, maybe this few things we talk about here have changed. But it seems like people are saying he's going to come out with a bang, lots of deregulation, reduction of sort of spending, reduced taxes. Do you see that as a boom, or do you think it's sort of just going to paper over the cracks?
But I think this is where people, I mean, miss the whole, understand or don't understand the economy here. I mean, this is not about what Trump can do right now and right here. This is about the consumer that now has been the U.S. consumer that has now been struggling for a year and a half, 2 years with very high interest rates. If you look at very basic things for the economy, for the consumer right now, then you see the credit card delinquencies are just going up, up and up. We see the same for mortgage delinquencies and so on. So this about that Trump comes in and does something fantastic. That is a narrative, and I come from the country of fairy tales with Hans Christian Andersen, and this is a fairy tale. I mean, there's nobody who can just take the Titanic, which has hit the iceberg, and then say, "Oh, this one guy here, he's going to do it all, all perfect." I mean, we're talking about $1 trillion of economy, not just the US, but trillions of dollars across the world. We're seeing everywhere that there is a struggle amongst the consumers. And then we think, oh, but this is coming out from Trump and it'll change everything and anything. To me, it's completely BS, honestly. And it's simply understanding this, that when the economy starts to turn, it's something that takes a while. You need to see the deterioration in different areas of the economy, and then you will see it falling into a recession. And that is unfortunately the path we're still on, and nothing has changed. I mean, it looks perspectives like average weeks of unemployment, which is how long are people being unemployed? How long are they unemployed when they become unemployed? Well, it's actually going up and up, and it's higher than it's been for a very long time. And it's when every time we see it moving up like what it does now, it's a signal of a coming recession. So I can point to these endlessly of indicators that's just saying things are not so great. And the only thing that the people that are talking about the economy so great right now are looking at are the NFP numbers, non-farm payrolls, which are on an average adjusted by 68,000 per month for the last 5 years. So I mean that we look into those and they are seasonally adjusted. And if you look at the December adjustment, it was the lowest we pulled out because December is a good month because people are coming into work there. And if you look at that, that is seasonally adjustment that they put in there has been the lowest we have seen in 20 years. And if you look at the part-time jobs, which is really when you look at NFP numbers, they just count one job for a job. So if it's a part-time job and I am as a person, I take on 3 part-time jobs to make ends meet, well, then it actually counts for 3 jobs in the NFP numbers, which, by the way, is also still regulated or revised. And we remember the revision we had in November of last year was 818,000 jobs was just removed like this. So all of the talk of how strong the economy is, I simply do not buy it. And I think we're much, much closer to a market top than most people anticipate and understand. So yeah, I hear the narrative. I hear what they are talking about with Trump coming in and whatever he can do, but that's part of the narrative you hear into a top. That's not what you hear at the bottom of a market. You hear that into a top of a market. That's where everybody gets euphoric, and that's what I see. I see euphoria unfolding. I say we are within. We'll have a strong rally here going into the inauguration or after the inauguration for a couple of weeks in the stock market, months if we are lucky, and I think the crypto market will explode to the upside. But it does not mean that the economy is fine. It definitely is not, and that's still where we're heading. And again, when we look at all the structural setups we have for the economy right now, people need to start to tell me why it is that we can see all these things that we have seen over and over and over again before recessions, and this time, by the way, oh, this will not lead to a recession. So I honestly sit tight and wait. I'm long bullish right now. The market, I think we're going to have a fantastic, as I said, crypto rally, but it's not the same as the economy is out of the woods just yet on this. And I don't think we will be, and we will fall into a recession. And you see, as I said, also the German economy is actually leading us into that, leading the US also into that. And the Chinese with that as well. So I think people are missing the point, missing the whole setup here, honestly.
Okay, yeah, a lot to touch on there because I guess the Fed is using this data to remain hawkish and to sort of keep interest rates where they are, and there's even talk about potentially raising them. So do you think that's a mistake that they're currently making?
I'm honestly, again, I have to. When we get to this and talking about raising rates at this point, if you look at the very start of the last 5 to 7 recessions, you'll actually see that inflation was lower before that, going into those recessions. At this point, the inflation level is lower than those. So the people talking about inflation being a problem at this point, I mean, again, if we have that kind of rollover that I'm talking about, then we have the worst standing point for a potential recession in terms of recession, because we were only at 2 point, what was it the other day here, that that really will give us a situation where we soon find ourselves in a deflationary scenario. And people in talking about inflation, you're talking about, well, yeah, they always do that. If you look at the FOMC statement in October 31st, 2007, you will actually see how the Fed was also talking about inflation there. There has been an uptick in inflation, and they are carefully watching that, and they will take further action if needed to make sure the inflation didn't get out of hands there. That is the same thing they are saying right again. But we have to remember in 2007 that when they were saying that, and we are, as I see it, the same place in the business cycle as we were back then, then inflation was not the problem going into those next months. The deflation was. I mean, that was the deflationary bust really setting off. So I think, again, because inflation is a lagging indicator, which actually tells us where we were in the real economy 6 to 9 months ago, that is why we are seeing and hearing these talks, because people are saying, oh, but things are, inflation is a problem. Inflation is not a problem at this point. Deflation will soon be. And that's because the Fed is way too hawkish at this point, way too hawkish. And we are probably heading into almost a recession before the Fed actually understands it. And I see in 25 here, we'll see emergency cuts. Again, coming back to 2007, 2008, you actually saw that how the Fed, as I said, the 31st of October was focusing on this. This was in the quarter where the economy was already contracting, and it contracted by 1.6% in Q4 2007, and the Fed was talking about inflation. I mean, it's so ridiculous. And in January of 2008, which was just 2 months after the FOMC statement where they talked about that, the Fed was panic cutting, first by 75 basis point by mid-January of 2008, and then by another 50 14 days later. This is how data dependent the Fed is. They probably are, but they are looking at lagging indicators. They're looking at things that are not in the front window. So, but what was happening earlier on, and that is a mistake. So I think they're doing the same mistake, and this time even more bigger than that. And we also have to remember, again, going into the inflation spike, what was it that the Fed was talking about? Yellen, she was talking about, we think the Fed will, the inflation rate will top out around 2.5% or 3% or something. It went to 9.1. So they are clueless, and I have to say that. So when people talk about rate hikes and so on like this, in a scenario where you have leading indicators actually been rolling over like they have, and we see that the job market is as fragile, especially if you look at the household survey, especially for certain months. In November, there was a net loss of 355,000 jobs in the in November report. December is different because there is always a better that's the Christmas month, so that's always better. But we see there the November month was just terrible, and I simply think that a lot of people are just missing that whole setup there, and because everybody wants to be positive, and that's nice, but it's not the direction of the economy at this point.
Do you see it going sort of similar way to what we're seeing in China, where we're sort of basically deflation, really struggling, and then I guess I'll leave it there.
Yeah, so China is now. I mean, China is obviously a crazy scenario, and they have had the largest real estate bubble that we've just seen unfolding for years and years. And everybody could say that this is not how you cannot build an economy on a real estate bubble. I mean, if you build your houses and the investment are there, that's fantastic because that adds to your GDP growth. But if nobody moves into those and those investments and those houses afterwards, it's like having dug a hole in the ground and now it's just there and there's no returns on it. And that's what you see. So you actually see that the GDP can go up very fast in those bubbles, especially because the property sector is such a big thing. And what you see by the end of it, when people are just leveraged up to their necks, and you have to think that I think the Chinese bank system is banking system is like 3 or 4 times larger than the US. I mean, just because they're propped up, all the real estate developers and people there. And if that starts to unfold now, and I think it is, and starting to see in terms of a deflationary, but that is, the very definition of very big deflationary bust. Well, it's not going to come down easily, and it's not something that is just going to be, a minor thing. We're right now seeing a deflationary bust, a train wreck in slow motion in China, and it can accelerate, and it will not be something that is good for the world economy, because obviously trade is good for the world, no matter what anybody else thinks. That's what it's good for the world and for growth. And if China is not, is we're seeing a drag on China, the Chinese economy, which is a big one, even though it's more secluded to the rest of the world, well, then it's a problem. And it's a problem right now also for, as I said again earlier, Germany and other economies in Europe are starting also to feel the pain of that. So again, I think people are completely missing the whole the point here, the picture here, and it's actually interesting because I go back to 2007, I go back to 2001. I remember the sentiments into those busts as well, and this time it's not different, but it's again what we hear. This time it's different. This time we got Trump. This time we got AI. This time we got all these things. 2001 it was the new economy. In 2007 it was different things. We hear that all the time. But we can just look at the numbers and we can look at the charts and we can say, well, are we really thinking that this is going to continue? I say the excuse me. So I think the Dow Jones has probably already topped in the US. I think the S&P and the NASDAQ will top within a few weeks, actually, and maybe a month. And then you have the crazy rally we're going to see in crypto will persist for some time, and there will be a narrative, but that will just speak of how more crazy the whole setup is, not that this is a sound economy. That for that to look at, we need to look at the consumer, and again, the consumer is not well.
Yeah, and if we stick on China and Europe, I think what we're seeing is that China, as you said, there's deflation due to the real estate, and they're trying to sort of manufacture their way, or create this production to sort of manufacture their way out of this sort of economic depression, and now they're exporting it to the rest of the world, and basically Europe is being destroyed by that. I think I saw statistics where in the UK, the chemical production has reduced 30% and since COVID, which is which is massive, and it's similar to sort of what we're seeing in Europe, and that there's an impact of energy prices on that, but also it's just really cheap supply from China sort of flooding the world so they can try and have growth. So that seems to be sort of almost bringing each other down.
Absolutely, and I think if you have something, if you have an overcapacity of things, and you want to, of course, you don't want to cut the capacity first. You want to bring, the cheap. You want to fill that capacity if you can, and try to sell your way out of it. And obviously, that will be through lower prices, and that's why there's a downward pressure on prices, as I see it. And again, when that is part of the equation when we talk about inflation and we talk about what's coming. And again, I can only say people are watching and looking right down in front of them, maybe even back out the back or the rear window, in understanding the world. And what they should be is looking ahead. And it does not look good right now. It does absolutely not look good. And I can only fear what the consequences of all of this will be, because we know when things are starting to unravel as it does in China and other places, there will be people not feeling this, and there will be some political and geopolitical kind of ramifications of this. So I think that we were heading into a bad period here, honestly.
Yeah, we'll have to see what happens. But you mentioned there that you think next, probably coming weeks, potentially month, is when we'll see a peak in sort of the traditional markets. I know when we last spoke, you had a price target of 6,100, 6,200, which there was a large gap from where we were, but it's hit the sort of the bottom range of that. So do you still see it sort of I guess double topping, or do you see it going a little bit further?
Now I think it goes a little further now, and actually I have the what I will call the final revision of it, because I said back in already in 22 that it'll go to around 6,100, and then you start to have some other fib levels that you can check and you can set your targets by, and it seems like we're going to around 6,500. I think that is going to be the level for S&P. NASDAQ around 24,000 is my target there. It could also actually spike a little higher there, but this is going to be the final part of that crazy rally. And again, as we go up this fast, sitting here in a year time, we will see that the levels will be completely different. Also, because if you look at the market evaluation or the market valuations right now, it's just skyrocketing. So since you and I talked the last time, now we are 205% on the market capitalization to GDP. And every time in history we go back, we can just take a look at it. We can also look at the earnings per share and so or EPS, sorry, so the price earning, that's what I mean. Price earning levels, obviously, price earning levels of Tesla is above 100, and people think, oh, that's okay, let's just go on. I mean, you need to have quite crazy growth if you're going to live up to that 100 PE level, because that's nobody wants to sit and wait for 100 years to get that. So either the company really has to take off in a serious manner from these levels here, from these earnings levels, or something else will have to adjust. And if we're going into a slowdown of things, then that PE level is ridiculously high. So you see that not just for Tesla. This is for just an example. If you can see for all sorts of stocks, and you can look at the Nvidia and all these also, where we have Palantir now also, where it's just been going sky high, and everybody just thinks, oh, this is fine, this is great. And obviously it is, nice for the shareholders, and but it's just also when we see something like that, and it's a little too frothy and a little too, been moving out too fast. Maybe it's because something is at the ends of thing and not the beginning of things. So I have to say, I can see the last rally here, and things are going to end, and the 6,500 is what I have for the S&P now. I think it's the final target, and that'll be it. And then it will not be from day one. People will feel the pain on the top and the stock market, and everybody will be all euphoric. But I think that's where it ends.
But yeah, so you don't believe the sort of the thinking that this time is different. AI is going to come in and revolutionize the economy. It's going to have this massive uplift in growth and productivity. You don't see that?
I mean, no. Let me just start with the obvious answer. No, I don't. I mean, the new economy in 2001 was also not a new thing. So all these things here is just what we hear into a market top. And this is the narrative, and people would call me a cynic, and I don't understand AI. Actually, I do understand AI. I've been working with that as well. So I do. And I also understand it's not something that is good for the particular company. It's good for the company to begin with, but it's not good for the economy, because you have to lay off people. So it's not like it's a magical stick you go in and it will also take time to implement. AI will be the leap, the very tool, the whatever we can call it, for the next industrial leap that we're going to take in terms of productivity and so on. But it's not going to save the economy and this market on a short-term basis. And when things are way too frothy and we are, everybody's been partying, then there will be this pullback. I'm not, on a bear, on, an internal basis here. I'm just saying, for the next few years here, we have been living in a fantasy world where we have been getting used to free money for some time. Then inflation came up, and we kind of trying to seem to adjust to it, but we don't, because we can see the consumers then struggling with it. But still, the financial market seems to be, this is all great and good. And now we got these, fantastic narratives we can talk about, and let's rally more on that until the moment where the shit hits the fan. That's when the economy starts to roll into a recession. The markets are telling us we're getting closer to that. There are clear weaknesses in the charts now. It is as clear. I just have to say, when I was standing in 2022 and I was looking at the FANG stocks, and I was saying, wow, I'm so bullish here. I have quite the opposite now. I am just saying, wow, I'm so bearish. Not right now, but soon to be, because there'll be one more rally in my setup, and after that, it's just for some of these FANG stocks, it'll be free fall for some of those, and with that, we'll see a lot of the markets going to decline. So no, this time is not different. It never is, and I know people will not like that, but because there's all the young and new people coming into this, and they will feed this bubble. But they will also be, many of them will also be the one that stands as the losers when we get to the top of it.
Yeah, and I think it's a good point in talking about narrative. We see one data point that comes in sort of weaker, and then markets crash, and then we see one data point coming in strong, and the markets go up. So it does seem extremely frothy depending on what everyone looks at.
Absolutely, yeah, and the market likes a narrative, a good narrative, and it's so much easier to say, just point to something that everybody agrees on. And I mean, this whole thing with psychology is, it's a very, simple thing to understand. And when we were standing down on the savannah as whatever kind of primates we were back then, we would probably have been looking at each other and saying, well, it's better to be 50 together than standing alone. And the guy who stood alone out there somewhere would be the fool, because if he was wrong, he would get killed. But if we were wrong, I mean, we were then 50 together, the risk of getting killed were smaller than as an individual person, as part of a group. That's why the herd mentality is so strong for us, and that's why we will, when everybody else is talking about, we'll just flock to that argument because it feels good. It feels really good for us. And this positive confirmation bias, we just oh yeah, and you see this and I see that, and this guy is just stupid. That's what we hear all the time. And again, I just have to say, I've seen it now enough. And I looked at the numbers. I looked at what we're going into in terms of the economy, and I can just say I see that the experienced and people are selling out their on their portfolios now, when it comes to Warren Buffett's, but also a lot of insiders. I see what Jamie Dimon is saying also on the consumer of the U.S. and so on and so forth. And I have to say, I see the same as they do. I don't like what we see in terms of the economy, the way it's heading right now. But people like a narrative, and they will be rather, pounding this in and telling me that I don't understand the effect that Trump can have on things. I mean, let's see. Let's see how it goes.
Yeah, and you mentioned there that you think before that you think crypto is potentially going to go higher. Do you see this as the point where it sort of it sort of diverges from the NASDAQ?
So yeah, I absolutely do see that there will be a diverging from between the Nasdaq and the and crypto here, because I think we still have the all season that is coming in, and I think that would be more dependent on liquidity that is coming into the system than it will be on actually fundamentals. And the Nasdaq and the S&P is just simply closer to the real economy. So I think we can see that the Bitcoin will actually rally some weeks after we see, and actually maybe up to a few months after we see the top in the Nasdaq and the S&P, and I think we're going to see altcoins rally even further than that. So I can easily see us going into April and May now with the altcoin rally.
Yeah, and I listened to a recent interview of yours, and I think you said 115 to 120,000 for Bitcoin. Is that sort of still where you think it will peak, or do you see it going further?
Yeah, I think we're going to see 115 to 123. I think if I have to get just one number, it will probably be 123. So 123,000 is where I think we're going. We have the final move in it. We have seen some weakness in it lately, and I think into the final wave here, we're going to see more weakness in Bitcoin. We'll see more strength in altcoins. We see the rotation we normally see into the final move, and that's just a normal cycle. Again, something we've seen before, and something that will again, convince people that, when you've been earning a lot of money, it's very difficult to become bearish, because you are sitting there and you're seeing, and the FOMO and all this is just, roaring. So I think that we will see that kind of animal spirit develop into that, and we will see that the altcoins will be the ones standing the longest this time.
Okay, yeah, that's an interesting thought. So, do you see as well, when we see that recession, will bonds sort of be the safe haven, or do you think gold will sort of be replace them as a bit of a safe haven? How do you see that playing out? Is just going to be as we saw in 2008 with traditional recessions?
Yeah, so I think again it'll be traditional in the way that when first, with all the air that is being pumped into the system right now, when I'm talking about air here, is that people are taking on more and more and more risk. And again, the example of Tesla at 103 price earning level is that is a risky thing. If you buy into something like that, you really need to get the growth in that particular company in order to get your money back. So that people are just buying into some of these things, and others, Nvidia and others also, you will see that is taking on risk. So yeah, I think this is where we will see that the air will start to come out, and yeah, it will be a strong crash at some point. But again, I have to emphasize that we will see that first in the sharp rally going into this. We are not there yet. We have the last phase of it, and the last phase in the Elliott wave model that I have, and that's going to bring us up to these higher levels.
Makes sense. So, Henrik, thanks so much for sort of gone gone all over the place. So appreciate you coming back on to speak further about this. My last question is, what is one message you want people to take away from our conversation?
I think it's like what I always say on these interviews here is just look. I mean, don't just feel the sentiment of the market, because if you do that, then you will be misled. You will be led into the crowd thinking, the sentiment, the hype, and you will feel right for a certain amount of time. You can be right with the crowd for a certain amount of time, but and you need to know when to pull your capital out. And I think that is where a lot of people, they simply have to understand that just because a lot of people mention it and say that things are great, it's not the same as they are. So I would say sit down, study, look at the things, and also look at what you've seen previously, and don't just take the numbers for what they are, especially not the non-farm payrolls, because they can change like a lot every month when they do their revisions. So look, study, that is what I think, and then be careful, because then into that top, it will be so difficult to take your money off the table, because the FOMO will be raging.
Yeah, great message. So thanks again. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
So you can find me at Henrik Zeberg on X, and well, I'm also a head macro economist at Swissblocks, so that's also a possibility to look me up there.
Perfect. I'll put it in the description, but thanks again for your time.
Thank you very much for having me on.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right, thanks again.